Let's test this audio. We got 30 seconds. I should be on. Matthew, tell me if all looks good to you. What's up, everyone? All right, excellent. We got Mr. Brent Kochuba in the chat. All right, giddy up, 15 seconds. Good show coming up. The lesson is private credit is just not that tight. It's a green tea day here. VIX pretty calm. Market chilling. Let's get it going. Good afternoon. Welcome to Chicago, Future of Finance. I'm Oliver Renick. It's 2 o'clock here. We got an hour left in the trading session. The stock's pretty calm. It's a green tea day. I was joking. All right, that's how you know the Oliver energy levels. Try to match it with the market. Expiry tomorrow, potentially a pretty big expiry, as Brent Kochuba has talked to us about on Friday. So there's just a lot of yellow lights. It's kind of a yellow market. VIX pretty calm right now, but still elevated. We are in the 20s, obviously above average, so there is some tension in this market. Today, the tension is showing up in the form of private credit after Blue Owl closed a retail-focused fund. Remember, private credit is an important part of the story in asset allocation right now in the financial advisor world. And frankly, we haven't talked about it too much on this show in the way that it is most relevant for the topics we do talk about on the show, options and advisors. There's actually a really important overlap. The overlap between private credit and options is that they both purport to be solutions to the U.S. Treasury portion of the portfolio for which many investors have been lightening up. The options folks say, if you want income, we've got it for you. And we've got very pretty clear payout profiles. The private credit world says that you need to diversify by going into different forms of debt. The catch is, it's just not that tight of an asset class. The liquidity is problematic. You also have risk that may not match, return rather that may not match the risk if you don't have long enough to stay in it. And a lot of these private companies have built up and amassed a pretty big storage of debt that it seems like they want to sell to the public market. It's not going so well. Look at Blackstone right now, down 6% off the highs of $190. The story about private credit becomes just about as important as the one in cloud. Perhaps there is an analog about just better ways to do things in a world that's demanding of productivity. AI has cut through all the fat in software. And perhaps the innovation of ETF products and options trading is cutting through some of the pitch deck for private equity. Blackstone is down 34% off of its highs. Look at Blue Owl, by the way, which was getting to be a bigger and bigger shop. They now have set a 45% decline. That's actually not even on the year. Hold on, it's worse for the year. There's my corrected bar. 52% Blue Owl now is down off the highs. So there's definitely a real shakeup happening, but if you zoom out, it seems like it shouldn't be too big of a concern. The XLF, the financial sector, is down on the day. I've pointed out the strength in regional banks. That chart has also slowed down a little bit. But if the question is about private credit contagion, if that poses a risk to the broader economy, I just don't see it right now, and I think that's what the market is telling you, with the S&P 500 largely little changed, 50 basis points, still very much hugging the range that we've been in, 6850, so a little bit below the 6900 midpoint of roughly our 200-point range. A few other things I want to just point out here real quick as we get the show started. Got a great show coming up, by the way. Brent Kochuba joining me as we get ready for the Money Show in Las Vegas. Nancy Tengler is going to be into the bell talking about the performance of her very good fund for the Cboe Exchange Traded Profile. Here's my tweet of the day. It comes, I guess, ex post. The chart of the day from JC Peretz is showing the cumulative advanced decline line. That is a pretty good looking chart there that tells us breadth and widening of the market is keeping us afloat. We've talked about dispersion ad nauseum. That theme still also remains. Don't want to miss the economic data, though. Can't ever overlook the importance of hitting clean numbers on the economy. 206,000, fewer jobless claims than expected. We continued to keep chugging along. So overall, I think the situation generally still remains encouraging, but on the price action, it just generally remains range bound, I guess. Brent, good afternoon, sir. SpotGamma, how are you?
Doing great, Oliver. How you doing?
Good. Trying to find a story on a day where the index movement and VIX movement is fairly calm, but private credit might be an isolated incident. I hope it probably is. Any thoughts on that, Brent?
Yeah, I was looking at some of the put trading in those names, and it's elevated for sure, and some of the put skews are lifting a bit. Those aren't super liquid options markets, and I suspect, obviously, if you're worried about some default risk or something like that, that's going to drive some flows into there. But when you look at broader measures of rate-related or credit-related vol, it's not really doing much. If you look at XLF, for example, granted that's a higher-level proxy for sure. IV rank there's a 16. So, none of this it seems fairly siloed at the moment, right? Now, these things are siloed until they're not, but at the moment there's not really any broader implication that I'm seeing in the option space.
It's picked up a tiny bit over the last week or so, just charting implied vol from the Thinkorswim, but the sector also has been coming off its high from January too. The regional banks, which looked really strong, they also have slowed down. That rotation that we've had has kind of lost the financials a little bit, but I think just when you see SMH, down 1%, I think generally still, the tech stuff ranks more important to me, but I don't know. I mean, that chart from JC shows that, participation breadth has been a really important part of the story, so we don't want to lose too many participants.
Yeah, and that chart is certainly an interesting chart, and it almost sort of screams a little bit in the face of some of the things that are flagging as issues. This morning in our founders note, we were talking about the fact that if you look at put skews across top stocks, they're all in the lower part of our compass, which essentially is just a way of saying is there's uniform put buying across all major sectors and across all major stocks, right? So, there's this weird thing where stuff is just not making sense, right? And so you look at that chart of extreme highs there, and or that advanced decline line is increasing. I'm surprised to see that, given the stuff we're seeing in the dispersion landscape, in the volatility landscape, et cetera. So stuff just is not syncing up at the moment. It's not making a ton of sense. I think that one of the things that we're picking up on here is it looks to us like there is a heavy amount of retail or buy side put selling, and that infers that there's actually a decent amount of dealer long put positions in single stocks, not necessarily index. That's some new data we just put out. We shared that with our subscribers this morning. And that could be one explanation for why we see these big ranges and then we kind of bounce back up, is that there's actually some decent positive gamma in the single stock space for dealers. That would be one thing that also explains some of the anomalous readings we're seeing. But look, Oliver, at the end of the day, this 6,800 to 7,000 range has been the range that we entered in October right at OPEX. And we've not left that range, right? It felt very volatile. It's felt like there's a lot of movements, but nothing is ultimately happening here. So it's very curious. And on our founder's note there, Oliver, if you just scroll down a little bit, you'll see the chart that I was referring to. There's the soft underbelly under 6,900. That's still true. That negative game is below, and I think that will persist through OPEX, through tomorrow and through to Monday. If you scroll down a little bit more, you'll see this chart of the uniform put skew that I was mentioning right here. The fact that all of these names are to the left of that chart in that yellow box is saying that we're synced up on this idea that people like puts over calls at the moment, and it's unusual to have such uniformity. And if I was just to show someone in the option space, or even somebody that's not in the option space, and said, this looks like there's high put values across all single stocks, what do you think, Oliver, the market's done over the last 2, 3, 4 days? You would probably think it's crashed, right? You would probably think there's been some downside, but we've not been getting it, right? And so there's something kind of holding this together. A lot of things don't make sense right now, and usually when that stuff doesn't make sense, it resolves to the downside, which is again, I hate sitting here being, kind of the boy who cried wolf on the worried about the left tail scenario, but that still just seems to be, the situation here, right? That things don't make sense, and that again normally resolves to a downside move. So a little bit worried, and I think ultimately what that means is, for me, sit on my hands or small bet on downside. and that's okay. You know, doing nothing to the upside is fine. You don't have to bet the farm either way here. I just think tread lightly because of these unusual signals.
So even again, this is just another cool way, right, to see the stock-specific characteristics versus the index level specifics. Correct, Brent? Because you're framing here of the risk reversal rank, and
that's
IV
right.
rank is just it looks wild. It looks like everything
in the line
got
there
pushed into one
you,
spot.
Exactly. That's correlation in a way, right? And that line is showing you the movement over the last 10 days. So that's what that line is. It traces out the movement of these products or these measurements.
So it's been going from right to left, the yellow line?
Right to left, and that's getting more and more bearish, right? That's what that is. Put values are increasing relative to calls, right, over the last 10 days. This is not like, oh, we paid the piper and we're trying to burn this off. We're shifting into that zone right now, right? Which it says bearishness on that single stock side. You look at spiders, Qs, they're about as far over to the left as you can get on that chart on that bottom left. So, why the bearishness? Why this move into puts? Why does that put skew lifting like that? Put options are absolutely getting bid right now. Right now, are they being marked up because dealer inventory is full? That's a possibility. They're trying to incentivize some selling there. Okay, fine. But OPEX should resolve this, right, and remove some of that positioning. If that's the case, in which case you would expect, again, an unpinning of this level that's dominated us. So, it's very strange. The one other thing I'll throw out there, Oliver, is Tesla call options are one IV rank right now. They're as cheap as you can possibly get. And, I was talking about a great trader that I once talked to who said, sometimes you just buy options because they're cheap. I don't know anything else about Tesla other than those options are screaming cheap while everything else is pretty expensive. And so I think that is one interesting upside proxy at the moment, just as an aside, because we're looking at the chart there.
Yeah, no, that's fun. I love anything Tesla related, Brent, because usually when you get big market moves, this thing is a major participant and indicator of kind of where the growthier parts of that market are going. And it's really important to note that it did make an all-time high just coming into the year. So while the mags, a lot of the big companies stalled out in October, Tesla still had a few months on it in its trend. And options, I see the implied vol, to your point. Yeah, implied vol looks lowest since April.
Yeah. And I want to add one other thing here, Albert, which I think is just interesting. I'm scrolling through all of the top sector ETF. What sectors are up today? Everything is down across the board except for, I'm gonna talk to you about these sectors, then you tell me what you think is happening in the world, okay?
Okay.
Energy is bid.
Defense is up.
XBI is up. Okay, fine. And then outside of that, you have ITA, which is the defense ETF, and XRA, which is another aerospace and defense. So energy bid, and defense's bid. Everything else is down across the board, and utilities, which is kind of a safe. So kind of like this proxy of like what's going on with everything is into puts, and then the only stuff that's up, you go, well, what's good? Energy and defense. What happened? What has to happen for energy and defense to get bid, Oliver? I don't. I'm praying that doesn't make sense, but it's odd, right?
I might be pulling up the answer right now, which is polymarket bets related to Iran, which was also a headline today. 75% no strike by U.S. On Iran by February 28th, but still, there's a 25% probability of a major world event that would be happening in that case. So I can kind of see your point on that, to where one could easily make a geopolitical argument that there are some risks maybe outside of the stuff we normally think about. But I guess part of that too, though, Brent, is, a lot of these, I think if you were to look at a lot of defense companies or a few of those other categories you mentioned, I think that generally they're going to kind of correlate with some of the other manufacturing kind of old world type of economies that seem to be doing okay right now. We've had this shift into, at the most extreme, software to hardware, but then we've also kind of had, the rest of the world performance is doing very good. I had a long conversation today about EM debt, and somebody was showing me the numbers on that. It's done great. So it's, hopefully not too worrisome from the geopolitical standpoint, but definitely shows up market-wise.
You totally could be right, and I'm by no means a geopolitical strategist, so I'm trying to infer anything. But what brought me to this is I'm looking for the leadership here, right? I'm trying to find out where are the sectors that people are going into? Because it's not the traditional tech stuff. Finance, as you mentioned, if anything, there's some boogeymans hanging out there at the moment. With the private credit stuff, and our rate's actually going to shift higher right now. TLT is getting a little bit of a mild bid at the moment. So, you go like, what is the leadership here, or what's going to bring us out of this? And now maybe it's next week where CRM reports and they say, don't worry, software's not dead yet. And NVIDIA reports and says, all good. Spending is on and AI, blah, blah, blah. Okay. But if the leadership is the defense section in energy, kind of like that's odd to me when most other things are drifting lower, can't catch a bid, right? And that's just one thing that really popped up to me as anomalous.
No, it's a great point. I mean, the chart for XLE looks, very consistent and pretty good, unperturbed, up and to the right. Okay, so this is fun though, because on these kind of quieter days, we find some of these things that maybe we wouldn't have been looking at otherwise if the big tech stuff were just ripping and it were vol crashing and market all good, or vol surging, market all bad. I like the idea of just buying something because it's cheap, which takes me back to the Tesla point, finding support at $400 in that range. If you think this resolves positively, maybe buy a call. If you think it resolves negatively, maybe buy a put then, right? You can kind of, rarely can you even maybe get a strangler or a straddle on a stock like Tesla because it's too expensive.
Yeah, that's true. And to that point, maybe this does resolve to the upside, in which case Tesla's still a big, component, and a decent amount of positive gamma rolls off for Tesla for Friday. So you could write a story where the stock is up 5% in a heartbeat. I think that's not shocking to anybody here. And that call is cheap. So if the market goes down, stock goes down, you lose your money. Well, it was a cheap call. Almost by any metric, they're cheap calls. And then, still, I look at some stuff for next week. We're talking about software under earnings. Something like CRM strangles or short volatility plays around that name, which has screaming high IV rank, is another interesting one. I think is some of those names to come up and report. The stuff that also is struggling, that crypto stuff still cannot catch a bid, even though the Trumps are out there pushing it forward, right? So, where do you go right now when everything seems to be flat to sort of declining? It's a bit of an enigma, and stuff is just not really lining up. It's like, where is the capital flowing at the moment? It's not terribly obvious.
Yeah. Someone in chat brings up a good something I want to address real quick, which is, I've heard this now for a few days in a row. People have said, they're generally worried about the big tech because they, quote, shoot the generals last. Since we're talking about defense, maybe we break down that illustration for a moment. Because while that might be true, the trouble of using that logic from a trading standpoint is that, yes, when the market crashes, the generals do fall last. But they generally don't fall. So you kind of start with the premise of, if you think the market's going to crash, okay, buy the put in Tesla, or NVIDIA, because the market is concentrated. If we lose those generals, then we're in big time trouble. But as we talked about almost all the time, generally the flows are pretty supportive. So, generally you don't bet on the generals getting shot. They usually stay standing.
Yeah, and nowadays, there's so much systematic call overriding in names like Apple and Google and stuff like that, where people own these, right? You own it in your retirement fund. To quote a Jim Cramer thing, never sell it, right? And how do you bring in income against that? You own bank stocks, right? You sell calls against that to try to generate that income. There's massive industries, as you know, Oliver, to the point of your show, with this systematic call overriding that pads these names, and I think then the beta of these names to the general market is a lot lower, right? They tend to be a lot more supportive, those mag names. So, I agree with you on that perspective. To that point, the software stocks and XLK really crashed a lot, right? 30% here. That bled into XLK, but that never really infected these mag names. Not only that, these mag names, if there's going to be a sector that leads us forward, who isn't on the side that AI is the biggest development that we have, like good or bad or deflationary, inflationary, whatever it is, you would think that those are the names that would offer some relative kind of safety in this type of environment if literally everything else is just part of the matrix and doesn't offer value anymore.
Yeah, no, that's fair. I generally want to err on the side of hopeful because it's probabilistically usually the right move. I will say to the kind of the concluding point on that subject is this IGV software ETF line, boy, it's desperately trying to hold on to that weekly trend line. It's not too far off of it. I mean, when you zoom in, we're still right there. So,
Yeah.
if that crash that we have from the top wasn't enough to break the big tech. Brent, the last point here, just really less than 60 seconds. Marc Lopresti, I know, is going to want to talk some of that geopolitical stuff too, is your founder's note. I'll conclude on the technical situation for tomorrow. Give us that last brief about tomorrow expiry and what you'll be watching.
Yeah, look, it's pretty simple here at this point. 6,800, if we lose that, I still think that is the moment for a bigger drawdown, and that's the sign that some of these, downside convexity will pick up. We broke that very briefly a couple days ago and admittedly bounced back, but here we are again, kind of just hovering over that line. And I think that people really need to be worried about that slippery downside. So where do you invoke that? It's under the 6,800 level. I would watch that pretty closely now as we move through OPEX. And I do think that, again, we're going to reset some positions here, and maybe that helps things start to sort of sync up a little bit, right? That just some of the anomalous behavior that we're seeing starts to sort of fall back in line with what's generally normal, and I'm looking for OPEX to maybe trigger some of that.
Okay, so tomorrow could potentially be a very meaningful day in trying to shout, pick a direction, all that type of stuff, right? Because expiry always carries extra weight. It should be higher volume for options for sure, higher volume for the market probably then too.
Yeah, I think that's the case. And again, it's removing positions that could be supporting or exacerbating, I guess, the anomalous behavior that we're seeing, right? And so, that is the theory as to why we would maybe have a little bit of a reset in the volatility space, start to sync some things up. And I think that resolves the downside, just because that's typically the way these unusual markets tend to again, line back up or sync back up, right? You get S&P drop down, 3 to 5%. Vol kind of blows off, shows a blow off or an ultimate bottom, and that allows the vol sellers to come in, reap some benefits or try to get some alpha there. Maybe NVIDIA then reports good in a couple of days. So, that's the kind of thing that I would be looking for here, kind of a 3% downside move in the S&P, which kind of syncs everything back up in our volatility models.
Get that index vol versus the stock vol to line up. All right, we're going to talk more about this next week. I'll see you in Vegas, Brent.
Yes,
My
sir.
show.
Looking forward to it.
Yeah, Paris, Las Vegas, 23rd to 25th. Our panel Tuesday evening, Vegas time. Perfect. Right before we get to go hit the tables. Me and Matt are going to roll over you in poker, Brent. Heads up, we're coming for the bankroll, man.
That's guaranteed.
All right.
Guaranteed.
Great stuff, Brent. Appreciate it very much. Thanks as always this week. Great stuff. Brent Kochuba, SpotGamma. 2-minute break. Then we're coming back. Marc Lopresti going to go through some Kalshi bets with me for the gamble. Don't miss.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back here. We got about a 25% chance, according to Polymarket, that the U.S. will strike Iran within the next month. I don't really like that number. Marc Lopresti is joining me from Market Rebellion. I hope that drops to zero, Marc.
Yeah, I do, of course, for anybody that would be potentially at risk in that kind of a situation. We never want to see military escalation, although it certainly seems like Iran is preparing for an escalation according to the president's threats, stepping up their organized drills, naval drills in the Straits of Hormuz there. Oil, of course, reacting positively if you're long oil, and oil's been trading at a level that is below what is typically considered to be a sweet spot, certainly for the oil producers and the downstream players in that space. So interesting to see how that plays out. But, Oliver, even when we did do that previous military action in Iran last year, the market, was some volatility. It did sell off a little bit, but ultimately it sort of took that news in stride, as it has most geopolitical stuff, whether it's regarding Israel or Iran. The market seems pretty largely unfazed.
Yeah. Today also we were talking about the private credit companies getting hit, Blue Owl closing that fund, whether it's geopolitical, whether it's sector specific type of risks. They largely seem contained. I think most of the overall risk this market is trying to move through. That's my take, but there's a wall of worry for a reason. I just generally favor climbing over it.
Yeah, I agree with you completely, and I think any one of these individual factors taken on its own would not be giving us certainly the kind of spike that we see today in the VIX, up about 5% since when I last looked at it on the day. But I think all of these things taken collectively, along with, of course, tomorrow option expiration, expecting higher volumes and higher volatility. There's the possibility that we get the Supreme Court's decision on the president's tariff policies potentially happen tomorrow, although, of course, we've seen this movie before. There's no guarantees there. That would certainly trigger some volatility if, as expected, the Supreme Court rules against the president. And as I've mentioned to you before on this show, it's going to be very important to break down exactly what that means, because while the court may say the president exceeded his authority under the International Economic Powers Act, the court will not, mark my words, Oliver, will not tell the president he's got to send back the money that's been collected on the tariffs. That just ain't going to happen. But we could see a vote that is technically, or certainly the headline news, SCOTUS votes against President Trump.
Right now, Polymarket has 26% chance Supreme Court rules in favor of Trump's tariffs. So fairly low to your point. U.S. did just score against Canada in hockey, by the way. That was not a market-related surge there. 25% Polymarket says, so it's uphill battle, it seems like, for tariffs here.
It does, but again, as I try to caution people, and regardless of how much caution and how much we try to educate traders, there will still be a knee-jerk reaction to that kind of a headline. SCOTUS votes against Trump's tariffs. But the question is, what's the ruling going to say, Oliver? And the ruling may be unfavorable technically. It may conclude that the president exceeded his authority under that Economic Powers Act, but it will not direct him to give the money back. It will not direct him that he will not be able to impose tariffs under other pieces of legislation. There's a lot of arrows in the tariff quiver, and the president knows how to use them.
Okay. I don't even know how they would collect money from tariffs. I think that so many people talk about tariffs in a way that's like not even, what are we going to track them all down? What are we, like anybody, we're going to track down the person who bought a shirt at TJ Maxx that was $5 more expensive now? But I get the point, which is that, let's look at Polymarket on how they define it. The market will resolve the yes if the Supreme Court of the United States issues a decision that reverses, vacates, otherwise overturns the U.S. Court of Appeals for the Federal Circuit's August decision in which they held that the tariffs imposed. They've got 5 executive orders listed. So to your point, even if this comes to fruition where they rule against him, it's not like the positioning of the president or the U.S. stance is really going to change in any way in terms of the commentary or the goals or anything they're trying to do.
Well, that's true, Oliver, and even more precisely, remember the what's being evaluated is just this one piece of legislation, the IEEPA. There are at least 5 other tools in the president's toolbox using executive order pursuant to which he could impose the very same tariffs. And that's really the point here. So the Supreme Court may rule against him, and he may just simply say, oh, you don't like it under column A? Well, how about under column B? And then, of course, that will get challenged and we'll be back in front of the Supremes. And in the meantime, it'll be business as usual. And look, we saw today that continued shifting in the trade imbalance in the U.S.'s favor. The tariff policies are working in leveling that international trading playing field for international trade for the United States. There's no question.
I might inform the audience here if they don't know that Mr. Marc Lopresti is a lawyer.
Recovering.
Or was.
Recovering.
Is. Yeah, okay, I like those details. Good perspective. Marc, one thing that I think I definitely want to hit with you because you put it on my radar. Obviously, you guys at Market Rebellion are always watching options flows and kind of stock-specific activity as well. One of the main themes has been staples, the strength within the staples category, which someone actually in chat earlier said the spread between semiconductors and staples, doesn't tell us anything good, basically. I feel like that might be a little bit of an exaggeration. Why not have, because the SMH still looks pretty good. It doesn't hurt to have another group like staples doing well. And there are, I think, trades in here, like a Walmart that are 5 below or something, it's good that staples companies are doing good. That means we're consuming. We saw the consumer data. The consumer data was good in the last reading. I know Walmart's off a little bit on earnings, but it just put in highs.
Walmart's off a little bit on guidance. We know, of course, earnings season is not about what happened last quarter. It's what we expect is going to happen in the upcoming quarter. And what happened to Walmart is no different, right? They beat on the top. They beat on the bottom. Overall, continued market share. My God, 15th straight quarter of double-digit growth. Their e-commerce sector growing by 27% on a year-over-year basis. That's an unbelievable number to grow their e-commerce by that much. And the thing that was the most interesting to me were the CEO's comments that he thought that we are starting to, quote unquote, get into a normalized pricing environment. And even more interestingly, that any pressure and price increases associated with two of our favorite topics, Oliver, inflation and tariffs, had been, quote unquote, absorbed and were easing in terms of upward inflationary pressure. That's incredible. This is an economic bellwether. This is a company that we look to determine not only the health of the American consumer, but of the GDP in general. This was a very, very good, I think, a very, very good report in this with this earnings call. And yes, did they miss what the forward guidance? The street was looking for $2.96 a share on a forward basis. The adjusted expectation, $2.85 a share. 10 cents a share doesn't seem to be a whole lot between friends, but let's also bear in mind that this company has done incredibly well. It did incredibly well in 2025, and of course has also handily beat the S&P's performance thus far in 2026. So a little bit of foam to be taken off the top of that one on any kind of a miss on guidance. That's what we saw here. But I take the news from Walmart's earnings as overall very positive, as you put it. And don't let the haters fool you and say that health and staples must be a rotation into safety. It can also be an indication that the American consumer and the American economy is doing pretty well, because to your point, people are consuming.
Yeah, I'm with you on that. Just doing a little chart work here on Walmart, maybe some kind of short-term support at 125. I could see just in this range. Nice to see implied vol dropping off post-earnings as it generally does. So a little bit cheaper than a couple days ago, or really any time within the past week to place a bet on Walmart now. And uptrend line that stretches for months. Mine starts in 11/25, November, okay? So That's a pretty good little 4-month uptrend there. And I do think, to your point, staples as well, that sometimes it's good to have something reliable and that is diversified from the overall market as well. Which, that chart, the Staples chart, sideways, 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 pop, doesn't really look like anything else other than maybe energy, which brings us basically full circle to where we started this conversation.
Yep, not surprising.
Do you buy crude, Mark? Last thought before I get Scott in here. WTI trying to make a push, gotta say.
Listen, I would say if you're looking for a serious pop, I don't know that you're necessarily going to get it, even if we wind up doing some form of additional military incursion into Iran. I think that there's just too many other factors, OPEC and otherwise. The supply-demand picture, as we've talked about when we last talked about oil, just remains and mitigates sort of heavily in favor of keeping pricing low. So I don't know that I would be betting, certainly not on this little geopolitically catalyzed upswing in crude.
Okay, all right. It's trying though. I will give it credit. Could be interesting. As generally I'm one who fades crude. I'm kind of starting to wonder maybe if I'm second guessing myself, but I generally for WTI got to see it before my eyes. Got to see the trend really, really move if you want to get long crude. Thanks for the thoughts, Mark. Good stuff. Appreciate
always
the look
a pleasure,
on
my friend.
the Poly Market Bets as well. Nice work. Marc
you.
Lopresti, CEO of Market Rebellion. All right, I like the idea of bringing Mr. Scott Bauer in on some of the commodity conversation, given WTI's potential break here above $66 and the general strength of the oil trade as well, which has looked pretty good there, comparative especially to some of oil's weaker moments. Mr. Scott Bauer, CEO, Prosper Trading Academy. Scott, basically same question to you. I don't spend a lot of time thinking about crude too much, but any chart that looks like it's trying to break out in a moment where the broad market's been struggling, I feel like should catch our attention.
Yeah, it definitely does. But, is it trying to break out due to technical or fundamental reasons? Or is it trying to break out because of, in this case, what I see is geopolitical reasons? And certainly, God forbid something happens, things escalate, we can see a sharp move higher. There's no question about it. President Trump has given maybe this weekend, 10 days, ultimatum. To me, I am not going to buy into something like that. I am, really digging into the fundamentals and technicals. So I'm not fading it here. You know that I have been a sell first, buy back later participant in the crude space for a very, very long time. I think the risk of doing that right now is too heightened for me, quite frankly, but I'm not buying into it. I would rather see something not happen, crude come down like I think it's going to, and then kind of trade in the pattern that it did for quite a long time. Okay.
So essentially look for more evidence, it seems like, kind of similar to the point I was making to some degree. I mean, it's not like you won't trade this.
No,
if it,
I will. I absolutely will. And and if it does break because something happens, I will look for an area up top to short it. I'm not comfortable shorting it right here. I'd rather see us retreat back to maybe 61, 62 area, put in some time there, and then I'd get back to the pattern that I had been following.
Okay, so that's a good point then. Okay, so basically, you're talking about kind of momentum trading. You view this as sort of a momentum asset where you want to see the momentum either redevelop to the downside or extend further to the upside.
Yeah, because for the way that I've been trading this, where it's a sell the rip instead of buy the dip, that narrative has kind of broken for right now. So just because I may still believe in that, from a fundamental or technical standpoint, the narrative is broken. So until it reestablishes itself again, I'm probably going to sit on the sidelines.
That's the difference between having a kind of core secular view for the space, right? Your kind of secular view of crude being generally something as an asset under pressure means that you really got to see momentum break to the upside to want to trade against your macro view.
Absolutely. And listen, there's plenty of things to trade out there, so I'm not going to force a trade that, that goes against the reason that I've been doing it for the last 9 months, right? If that pattern is broken, okay, it's broken. If it reestablishes itself, great.
Yeah, I like that. Tell me about, you're watching the private equity or private credit stuff today, Scott. Some of the hits being taken by Blue Owl, by Apollo. That's, I think, the main kind of theme of the day. Owl's down 7%. They closed one of their kind of retail-focused private credit funds. Apollo, by the way, this chart is trying to break down, speaking of new momentum to the downside.
Yeah,
Apollo's,
look at that.
Yeah, not good. Should we be concerned?
No. There's always concern there, I think. I don't know how much is hyped up in the media right now, how much is really under the surface, even beyond Blue Owl and in Apollo. I think that's the bigger concern, is that there might be more to come here. So I think it's definitely something that bears really close attention to, and hopefully we don't see some sort of epidemic here, or things get worse. But I wouldn't count it out. I really wouldn't.
The thing about the private credit kind of pitch that they're giving, Scott, is I feel like options can answer a lot of the portfolio allocation off. The pitch from the private credit side is you got to have something different in your bond side of the portfolio. Other than, you got to have something different than big tech concentration U.S. equity. It's kind of a similar pitch that a lot of option strategies have argued as well. Let us generate the income for you for bonds. Let us diversify. Let us protect the downside. I don't think private credit's got any of those positives to it, honestly.
No, it's a definite riskier place to be. The narrative of generate some safety or income, I agree with that in principle. But you get a situation like we're in right now, and it's real. This is not a situation where in the past I'll liken it to like a Citron coming out and say, oh, we're shorting this stock because this is something more systemic, I think. And this breakdown in Apollo, I'm looking at the chart over here. It's got basically, to get to the Liberation Day lows that we saw of 105, 110 area, that to me would be a line in the sand.
Okay. The rollover in here is definitely very real. Chart wise, it seems like you start to break, you might get some tradable ways here to express very specific kind of bearish views on the group. I think that just sort of the risk reward doesn't strike me as being there. Liquidity is so important for so many investors, and private credit without that kind of liquidity, these types of days where they close up funds, just gives all the ammunition back to the critics of the asset class.
Oh, it sure does. There's no question about it. The liquidity is there, and it is certainly tradable, whether you look at the entire space or an individual stock like an Apollo or a Blue Owl, whatever it is, to express an opinion. But like I said, the volatility in that space, which then really kind of flows through to the equity space, and it flows through everywhere. If there's something that is maybe not life support, but critical, that's going to flow through everywhere, because obviously that touches every aspect of the marketplace.
Yeah, hopefully the financials will stay intact, basically. I'll watch XLF. Hopefully that line in the sand holds. Expiry tomorrow. Scott, tell me what's on your guys' agenda for big option session into the weekend, as we still are sitting pretty range bound in this 200-point thread that we've been in.
So it's interesting, because besides what we may or may not hear from the Supreme Court, which came out a week ago that starting on the 20th, they may start commenting on the tariff situation. So between all of the talk about U.S.-Iran, I think we go into the weekend with volatility heightened quite a bit. I don't think that anybody wants to go in to this weekend long. I'm not saying necessarily people are going to take big short positions. I think we're going to see vol really hold itself tomorrow going into the weekend. Also, we get PCE tomorrow morning, right? Is that going to kind of reinforce what we saw from CPI last week with the numbers coming in a little lighter, maybe really suggesting that, okay, maybe inflation is starting to get under control? Or are we going to see a report that, oh man, here we go again? It's sticky. So I think that we could see a busy day tomorrow. I would not be surprised to see vol pop quite a bit going into the weekend.
Good point. To that point, let me pull up real quick the economic data for tomorrow, because the number looked pretty good today for, jobless claims.
Weekly
again.
jobless was good. Continuing claims ticked up a little bit. Obviously, that trade deficit number was, I'd say it was a surprise to everyone, especially after the comments we heard from the president yesterday. So I think that definitely throws into some question tariffs, what the effect on the economy really is. In a broader sense, I think that throws into question even more so, can we trust the economic data coming out? We'll have to see how that plays out.
GDP 2.8%. Boy, it would be nice to see a 3 handle on that. I certainly wouldn't mind.
A 3, and from what we've heard, there could be a 4. Some are expecting a 4, but 3 would certainly be nice.
Yeah, a 3 on GDP, and then maybe divide it by 100 for 30 bips on the month over month. Stay with the 2 handle on PCE year over year. That would be the ideal combo, right? We hit
ideal combo. That would absolutely be not too high on GDP, to show that, oh boy, we're running away with things, and certainly not high on PCE. I don't think we want to see a real low number on PCE either. I think something just right, in, like you said, mid 2s. Little over 2%. I think that would be really good for the market.
Yeah. More messages of growth while still getting some of the disinflation trend would be really good. Saw a commentary from Goolsby. He's ready to cut. That's, generally been the case. But for, more and more folks to say we're kind of in the clear to cut, a few times this year. Maybe it doesn't happen immediately, but that consensus growing would be nice if we were doing that in a 3% plus GDP environment.
The consensus growing is great. I think what people have to realize is whether there's a 25 bip cut in March, April, or June, it's going to happen. In the long run, what's the difference, right? So I agree, especially because of the shutdowns and so much of the data being delayed, the last several months, ever since October, really, and maybe some of the data kind of being skewed. I am definitely in the camp of being safe and not making a move until the right people, the Fed, whomever it is, are really comfortable that the data is pretty accurate. Yeah.
I think the market generally, I don't know, they were buying bonds, which makes it a little bit confusing, but I think that generally the market believes it because stocks are still pretty elevated overall, very close to highs. The bid into the bond market maybe suggests there's been some degree of doubt about those numbers. Do you think that's why bonds are taking a bid? They're looking at the data, they're going, this isn't, the story goes deeper.
It definitely does. And, 2 days ago or 3 days ago when we were looking at almost a 3 handle in the 10-year, I would have said, boy, there is something really under the surface here. Now, we're only at 409. We're only, 9 bips above that or whatever it is right now. But yeah, this bid that we have seen into the bond market over the last several weeks, where we've seen that 10-year come down really quickly from 430, I think people are looking under the hood and saying, there's got to be something more here.
Yeah. TLT catching a pretty solid bid, let go a little bit of it in the past few days, but still has definitely been seeing some buying appetite. All right, inflation tomorrow, GDP as well. Could be a pretty busy day. You got a favorite trade around that, Scott?
I wish I did.
Macro, or you still just like the stocks?
Maybe some individual stocks. I do like some of the cyber stocks here, which I think are starting to put in what looks like could be a bottom. Palo Alto really rallied off of those massive lows after earnings yesterday. Now, it's down, less than 1% today. ZS is another one. I think that is really a space to watch here because I'm starting to see some bottom feeding coming in. And so I like the leveling out we're seeing in that space.
Yeah, Zscaler you mentioned, trying to find some stability around 170 bucks.
Yep.
Looking for some dip buying in the beat up names. Okay, nice.
Yep, you
like
got
it.
it.
Scotty Bauer, appreciate it, sir.
Have a good one.
Good thoughts ahead of tomorrow. Do have some pretty good, important numbers coming out for sure tomorrow with economic data. I'm going to run through the risk radar and more. We come back. Buffer Innovator break. Back in a second.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. All right, welcome back. I got a few main thoughts going into tomorrow, which is going to be a pretty big potential culmination of the sideways range that we have been stuck in. Even though it's a green tea quiet day for markets in this particular session, there is still churn underneath the hood that's worth paying attention to. I really like the fact that Brent pointed out Tesla volatility is cheap. I think that the main story of dispersion is one that is approaching probably an expiry date. Let's hope it's tomorrow, and let's hope it resolves by next week to the upside. But the main theme of correlations, which have been starting to rise a bit here, it just hasn't quite shown up at the index level. My chart of VIX, which is very apish and primitive with the uptrend line, still makes me a little bit concerned about the short-term potential, but it also just means the swing could be big. We could have potential for breakage of our 200-point range in either direction, and there could be vol attached to either one. However, It looks like right now, if I had to guess, I would say the breakout to the upside probably happens as volatility subsides, given that VIX is above the average now. It's easier to see potential stocks up, volatility up events when vol starts at a lower baseline. But we've been spending the better part of a couple months gradually pushing that baseline for volatility higher. Now, that being said, the market has still held on very well for the ride. My chart of the day, again, which comes from JC Peretz, I think was a very key look at the breadth of the market, which has started to widen out, which of course is a very good thing generally. If you look at the NYSE new highs, by the way, this is a pretty decent looking chart as well that shows us we've got breadth that's carrying through in the market, and in a way that oftentimes can result in negativity, but there's no correlation on the general index level. Here's the breadth for new one-year highs. Look at where we just were last week. So we haven't fallen very far at all in terms of the breadth that's helping keep the market afloat while the mags churn. That's my conclusion from this week, is that the horizontal range-bound market can only have so many more sessions ahead of us. If it doesn't get resolution with the market pushing towards 7,000 by the bell tomorrow, maybe the U.S. will give us something to cheer for. There we go. We take the lead, Maddie, up by 1. 3-2, 2-1. There we go. I will see you guys next week, Las Vegas for the Money Show. Me and Brent Kochuba will be there talking about options boom that's happening here in Chicago, what it means for traders around the world, what it means for the portfolio. Thanks a lot for tuning in to Chicago Future of Finance this week. I'm Oliver Renick. Have a great trading session for expiry tomorrow. Good luck, and I will see you on Tuesday from Vegas. Might pop in on Monday too. We'll see how the action goes. Have a great night.